my God! What? My bank?
In 2008, a man named Lehman woke up to find his bank no longer existed. Not the man, the bank. Lehman Brothers, 158 years old, gone in a weekend. But here's the strange part. Nobody stole anything. No vault was robbed, no fraud was discovered that morning. The money just evaporated. And a system that let it happen? We built it on purpose. This is the story of fractional reserve banking, the financial architecture that powers every economy you've ever lived in, and the uncomfortable math that makes it work right up until the moment it doesn't. Let's start with what sounds like a simple question. Where does money come from? You probably think it's printed by governments, minted in official buildings with security guards and serial numbers. And sure, some of it is. But most money? Most money is created by regular banks every single day, out of thin air, legally. Here's how. You walk into a bank and deposit $1,000. The bank says thank you, updates your account, and you walk out feeling secure. Your money is safe. Except the bank doesn't keep your $1,000. It can't, because if it did, it couldn't make money. And banks exist to make money. So instead, the bank keeps a fraction of your deposit. Let's say 10%, $100. The rest, they lend it out. Your neighbor comes in asking for a loan. The bank gives him $900 of your dollars. He takes that money and deposits it in his account, maybe at the same bank. Now the bank has a new deposit, $900. They keep 10% again, $90. They lend out the rest. Someone else borrows $810, deposits it. The cycle continues. Your original $1,000 just became $1,000 plus $900 plus $810 plus $729, and on and on. By the time the math runs out, that single $1,000 deposit has created nearly $10,000 in the economy. One deposit, 10 times the money. This is called the money multiplier, and it's not a trick, it's the system. Now, you might be thinking, that sounds insane. You'd be right, it is insane, but it's also brilliant. Because fractional reserve banking does something magical. It takes idle money and puts it to work. It funds businesses, mortgages, infrastructure, growth. Without it, economies would freeze. There wouldn't be enough money to go around. Credit would vanish. Entire industries would collapse. So we accept the trade-off. We let banks lend money they don't fully have because the alternative is worse. But here's the part nobody mentions in economics class. The whole thing only works if everyone believes it works. Think about what actually backs your account. Not gold. We left the gold standard decades ago. Not cash. We just established the bank doesn't hold your cash. What backs your account is a promise. The bank's promise to give you your money when you ask for it. And that promise is rock solid as long as you don't ask for it at the same time as everyone else. Because remember, the bank only keeps a fraction. If 10% of depositors want their money, fine. 20%? Manageable. But what happens when everyone wants their money at once? The bank doesn't have it. This is called a bank run, and it's the nightmare scenario baked into the system's design. Britain, 2007. A bank called Northern Rock. Rumors start spreading. The bank might be in trouble. Mortgage-backed securities, subprime exposure. Details don't matter to depositors. What matters is fear. People start lining up, not to rob the bank, just to withdraw their own money. The line grows. News cameras arrive. The footage goes viral before viral was even a common word. More people see the line. More people panic. The line gets longer. Northern Rock had billions of assets, but assets aren't cash. You can't hand someone a mortgage-backed security when they ask for their savings. The bank failed, not because it was broke, but because everyone believed it was broke at the same time. The belief became the reality. So governments got smart. They created deposit insurance. In America, it's called the FDIC. In Britain, the FSCS. The promise is simple.
Even if your bank fails, your deposits are protected up to a certain amount. This does something psychological. It stops the panic. If your money is guaranteed, why rush to withdraw it? Bank runs became rare. The system stabilized. Problem solved. Except for one small detail. The insurance fund doesn't actually have enough money to cover everyone's deposits. Not even close. The FDIC insures about $9 trillion in deposits. Its insurance fund? About $130 billion. That's less than 2%. The system works because we all believe it works, and we believe it works because the government says it does. See the pattern? Now let's add another layer. Banks don't just lend to people, they lend to each other. Every night, banks that have extra cash lend it to banks that need cash. It's called the interbank lending market. The interest rate they charge each other? That's one of the most important numbers in global finance. This system keeps money flowing smoothly. Banks balance their books. Everyone goes home happy. Until 2008. Lehman Brothers collapsed on a Monday morning. By Monday afternoon, banks stopped trusting each other. If Lehman could fail, who else was hiding bad bets? Which bank would be next? So they stopped lending to anyone, even to other banks. Credit markets froze, not because there wasn't money, but because nobody trusted anyone else's promise to pay it back. Businesses couldn't make payroll. Trade finance evaporated. The global economy came within hours of a full system shutdown. Fractional reserve banking works beautifully when trust is high. But trust isn't a fraction. It's binary. It's either there or it's not. And when it's not, the multiplier runs in reverse. Governments stepped in. Central banks flooded the system with liquidity. They became the lender of last resort. They printed money, trillions of dollars, euros, pounds, yen. They bought bad assets from banks to stop the bleeding. They dropped interest rates to zero, then below zero in some countries. And it worked. Mostly. The system survived. Banks reopened. Credit started flowing again. But the uncomfortable question nobody wants to answer, did we fix the problem, or did we just make the system bigger? Today, global debt is higher than it was in 2008. Banks are larger. The money supply is more inflated. Fractional reserve banking is still the foundation. The ratios are slightly different, the regulations somewhat tighter, but the core mechanism is unchanged. We still create most money through lending. We still rely on trust. We still operate on a system where the promises exceed the assets. Because we don't have a better option. Every alternative comes with trade-offs we're not willing to accept. Less credit means less growth. More reserves mean less lending. Tighter rules slow down the system. So we keep running the same playbook. We've decided that periodic crises are an acceptable price for continuous growth. There's a phrase in finance, money is just a shared hallucination. It's meant to be provocative, but it's also accurate. Money works because we agree it works. Banks work because we trust they'll return our deposits. The system works because we believe it's stable. And most of the time, that belief is justified. Until it isn't. The next crisis won't look like the last one. It never does. Maybe it'll be triggered by crypto, or climate risk, or geopolitical chaos, or something nobody's even thinking about yet. But when it comes, it'll follow the same script. Trust will crack, promises will be tested, the fractions will be exposed, and we'll all remember that the money multiplier works in both directions. So, here's the thought you're left with. Right now, at this exact moment, the global financial system is working. Your bank account is safe. Credit is flowing. The promises are being kept. But it's working the same reason it worked in 2007. Because everyone believes it will keep working. The question isn't whether that's sustainable. The question is, what happens the moment we stop believing?